Hello, everybody. Today we're going to be talking the four steps of mortgage approval, from pre-qualification to funding. Let's go. So you guys might have heard of a lot of terms such as pre-approval, full approval. So let's go through each of these steps and their differences, and let's get right into it. So the first step is going to be the weakest step, and this is called pre-qualification. Basically, a mortgage agent is going to ask the client, hey, what is your income, credit score, and down payment? And the client will tell them. And the more accurate the client is, the more accurate this number is. So basically, nothing is verified. And maybe some people say, oh, I make money, maybe it's unreported income for whatever reason. And they think they didn't know that they can't use that. Uh, maybe it's like a cash job they had, or like they don't even know, they just check their credit score from some website that's not one of the big, credit bureaus. So um, basically, the information might be wrong or invalid, or the income cannot be counted. So it's an estimate of the max purchase price and what kind of interest rates you can be given. So in order to move to the next step is called pre-approval. And for pre-approval, the difference is that the main difference is the mortgage agent will get the client to sign a mortgage application form, and this gives the mortgage agent consent to do a little check on their credit score. And at this point, usually the mortgage agent will ask for a bunch of documents to verify their income, and they might say, "Oh, you didn't include this rental income that we can count 50% of." Or they could say, and this down payment is a gift from, it's borrowed, so you actually can't do that. Or, or you can, so basically it might change the numbers a bit, and you might be able to borrow more or less. Basically, at pre-approval, they're saying, hey, we like you, the borrower. The borrower has been qualified for the mortgage. So you can do something called a rate hold, usually for 30, like 1 to 3 months. You can start putting in offers now. It's good to have a pre-approval before working with a real estate agent, because it's good to know the seller's minimum expected price. And if your pre-approval is less than that, then you should definitely skip the property to save yourself some disappointment and wasting time and gas. So now that you know the budget, putting in offers with a condition of finance is still recommended, because just because you're pre-approved, it doesn't mean that you will be approved to buy any property under this purchase price. Because if you look at the lender's perspective, the most two important things for them to research is you, the borrower, uh, and number two is the property, because that is their collateral. Depending on how much you put down, especially at the beginning of the mortgage, actually the lender is really the one who's really owns the property. Even though you own title, if you don't pay, they will take title, and they don't want to take title of something that is, uh, not good, at least in their eyes, or non-marketable. That's what they like to say, or something that takes a long time to sell, risky, right? So to get from pre-approval to full approval, so what happens is with a pre-approval, you put in an offer or a condition of finance, usually around 4 to 5 business days. And then what you do is, on the once you have a conditional offer that was accepted, you're gonna verify the property. And sometimes, unless you have a accepted agreement of purchase and sale, a lot of underwriters for the lenders don't want to verify the property because it takes a long time. So you kind of have to do it this way. But you might be able to find someone to verify the property, so you can do a firm offer beforehand. But it is more unlikely, and there might be fees because they have to work really hard to really investigate. So if you put in So basically, they have to check if the property is qualifies, according to their requirements. They want something that will hold its value. So the example, they don't like hotels that have been converted to residential. I've had this issue before, and they want 20% down or they won't do it. Some won't even insure, sorry, fund properties under 500 square feet, or maybe places in the middle of nowhere. So after they verify the property, they can give you something called full approval. And this is good news for you. And basically, you can make your conditional offer firm at this time. And because the property, as well as you've been qualified, right? You've been qualified for the mortgage and verified as well, has confirmed to be qualified for mortgage. And full approval, the property has been confirmed to qualify for the mortgage. And yeah, make the conditional offer firm. So at this point, you're going to be given full approval. However, there's going to be something called, as you know, between the offer becoming firm and closing date, which is also known as the funding date, there's going to be 30 to 90 days because mortgage lenders need time to prepare the money for you. It's a lot of money, right? So they're going to, between full approval, you making the deal firm, and funding, you're going to be given a list of conditions of approval. And just make sure, if you're in this position, to meet these requirements and up to the closing date. So I'll give you some examples. One of the most common is that you obtain insurance that is satisfactory to the lender, and usually they're pretty lenient. I had a client, if you have a condo, usually the maintenance fee will already have property insurance, which covers fire, so you don't need to buy additional. If it's a freehold, you need to buy something. It's around 75 to 100 per month per property insurance, and this will cover your property for fire and other damages like that. And it's good for your lender and you because it protects their collateral. You also want title insurance. It's mandatory if you're getting a mortgage. If you don't get a mortgage, it won't be mandatory usually because if someone steals your title, it's only your fault that you didn't get title insurance. Title insurance is around 250 and it's a one-time fee for until you sell the property. So some other of my clients' conditions of approval I've seen in the past are that they'll say, hey, we want to verify that your income and credit score, even though we checked already, that you don't quit your job before closing. They might check again that your credit score doesn't tank before closing, that you don't go ahead and get a million new debts like a new Ferrari with like $2,000 a month payment or something like that. Then they might not fund you on closing date, which is step four. And if they don't fund you, you're in big trouble because you won't be able to close and you're going to lose your 5% deposit. So that would be really bad. So if you're in this step, read the letter really well. I just want to go over some, this is a real life condition of approval from an actual deal. I made sure there's no confidential information. So let's go over, some of them. Basically, you know, um, the lender needs to give you disclosure. This is not a big deal. They don't want tenants in common. They want to make sure down payment, and income is all good. Um, this is a what's it called? A mortgage, mortgage insurance. They approve. Make sure they approve. It depends on that. This is an insured mortgage. It's less than 20% down. No secondary financing. They have to find out that you can't get money from other places for your down payment, and just don't want you to have more debts. This will ruin your GDS. You must be single family, right? So you can't like rent it out to like few families. Um, well, sorry, yeah, owner occupied, and needs to meet your zoning bylaws. So if it gets zoned for farming instead, might be in trouble. They must receive the MLS and APS, and all the Schedule A and Bs, and the realtor will be in charge of sending that to make sure that the borrower is not in default. So basically, you know, don't do financially irresponsible things. And yeah, title insurance that, the taxes and maintenance are not higher than what was stated. So make sure to the MLS listing was accurate because if it's a lot higher, it might ruin your GDS TDS ratios and you might not qualify for the mortgage anymore because it's more risk for the lender. Here a little more, just confirmation of previous employment as well. And yeah, and two more things are that the child care benefit, if you're receiving any, is still, active and legitimate. And also, if some people say, oh, their debts, maybe they have some debts that are ruining their GDS TDS ratios, and they promise to pay it off by closing. So in this client specific case, it says they will pay it off in time. Um, yeah, so that's pretty much the difference between the four steps and how it applies to, um, buying real estate. I hope you enjoyed the video. Please reach out to me at the info below, and I put all the steps in the comments as well, so you can take a look. Thanks for watching.